Elon Musk defended the dip in EV growth yesterday after reporting lower than expected earnings. Take a listen.
As people have seen, the EV adoption rate globally is under pressure, and a lot of other auto manufacturers are pulling back on EVs and pursuing plug-in hybrids instead. We believe this is not the right strategy, and electric vehicles will ultimately dominate the market.
Elon also announcing that Tesla would be starting production of new affordable EVs by early 2025. A lot of investors cheering that news. Joining us right now is John McNeil. He is a DVX Ventures CEO and a former Tesla president. Good morning to you.
Good morning.
So tell us how we're supposed to think about this, because I think a lot of investors were both looking at both the sales piece, which is the decline and what's happening to EVs. The bulls are saying this is great news that the lower-priced vehicle may be coming. Unclear what the timeline really looks like, because robotaxis are also apparently part of this. And then there's a CapEx piece of this, which is how much money they're actually going to spend to do this. It seems like they're pulling back a little bit on some of their sort of big plans to sort of completely remake these factories, and are sort of taking a middle path in terms of using some of the facilities they already have. Is that a decent summary of what's happened on that call?
I think that's a decent summary. I think you had kind of two contrasts yesterday. You had the GM earnings before the market, and you had the Tesla earnings after the market. GM did a triple beat, and they are getting through their production issues and now ramping EVs, which I think creates demand challenges for Tesla, because there's so many now EV alternatives coming to market. And so I think they are having to answer the pressure to have lower cost EVs.
Right.
At the same time, they're trying to move the story to autonomy and the longer term autonomous vehicle story.
For the investor, though, today, who's thinking about Tesla, do you have to think about it? And I think he's made the case. You have to think about it as an autonomous vehicle company long term to capture the valuations of where even Tesla sits in terms of the stock price today.
Yeah, I think there's a little bit of, hey, look over here, when the core business is weak, let's recast a different story. And I think there's a little bit of that going on for sure, because their core business is weak, and they were straightforward about that. But I think, to support a valuation, you've got to believe in this recast into autonomous.
Okay, so straight up, do you believe it?
Well, I think there are already two companies that are doing driverless cars, and so there's a race where two are already out there.
Right.
And Tesla, if they can get there, would be the third. And I do believe that cars need to be autonomous. 10 years from now, you probably won't buy a car if it's not.
Okay, so that's 10 years from now. But the question is, given that there are already vehicles that, I mean, they have a totally different kind of rig, LiDAR, radar, lots of other kind of sensors. It's a very expensive product. I'm thinking of Cruise and the like, and Waymo.
Yeah.
Do you think that Tesla can do it, and do it with the tech stack that's already on the vehicle, which is to say that Elon has said repeatedly he wants to be able to do this whole thing with cameras and processing power?
Yeah, I think that's the big question. Like, we've been waiting since 2015 for the finish line to arrive, and the finish line keeps moving out and out and out. And people that work on this problem say, hey, we're 95% done, but the last 5% is like as big as the first 95%. And so where that finish line is when we finally get there, whether it's Tesla or others, I don't think anybody knows. But we're closer than we've been.
And in terms of these more affordable vehicles, do you think those will compete well against what you're seeing out of GM and what you're seeing out of these other car makers?
I think you need you've got to open the market, and the broad market is at the lower price. And so in a couple of months, you can buy a Chevy Equinox after the tax incentive. It's like $27,500 for a 300+ mile range car. That's a small SUV. And there are a number of those vehicles coming out, and I think that's going to be formidable competition. It's going to give the consumer a lot more choice.
Should we be more concerned, though, about the competition, or more concerned about the idea, even, that the EV adoption is not staying at pace, right? I mean, that's the sort of bigger overhang of the whole situation. Are people going to go to hybrids? Are they going to stick with combustion engines? What's really happening here?
I think, like, we all knew the first quarter was coming, and what happened in the first quarter was most of the manufacturers lost the tax incentive credit. That is now back. So I think we're going to see very different numbers coming out of the rest of the year. because it was a slow first quarter, because consumers are smart. They know if they wait a few weeks or a few months, they're going to get it.
Is it that if they wait, they'll get it, or is it just that this market doesn't work without government incentives?
I think if they, it's a little bit of both. Like you've got to make EVs affordable, and so the government's helping while the car manufacturers bring their prices down and their costs down, and those cost downs are happening. So I think when you have like a Chevy Bolt, and that's priced in the 20s, you've got a very viable car without tax incentives, even more viable with tax incentives.
But the hybrid situation is a real one, too. I mean, we just had a car manufacturer, a car salesperson, Group 1, who heads all these car companies. Said consumers really want hybrids, too, when they're walking in there.
Yeah, there's a difference between hybrids and plug-in hybrids. Hybrids tend to be more expensive than gas, so it doesn't answer that cost issue or price issue. But plug-in hybrids, you can get the range that most people drive every day with a plug-in hybrid. And so I think you're going to see people leaning into plug-in hybrids, and that's where GM is.
Let's talk real estate. Because if you are a potential buyer, maybe seller out there, the state of the housing market is a little bit baffling and could be frustrating. According to data out today, newly built homes are on the rebound, reaching their highest level since September of last year. But that's newly built homes. This data comes as buying a home, though, is getting costlier. According to one new study, you must now make at least $120,000 a year to afford a median-priced home in the United States. But wait, there's more. According to Redfin, nearly 40% of homeowners would not be able to afford their current home if they had to buy it today. Now, if you lived there 20 years, totally get that. But, recently, that's a little bit weird. So is the dream, the American dream of owning a home, getting further out of reach? Joining us now is chairman and co-founder of RE/MAX, Dave Liniger, who came in from Denver. We appreciate it, Dave. Thanks for joining us. Can you give us some good news on the housing market? Because even successful couples are looking at homes and going, we do well and we can't afford anything.
I think the only good news is we're getting closer and closer to the end of this cycle, to where it's going to turn around.
Okay, what is the cycle?
Well, the cycle is extremely high interest rates versus the 2.5% to 5% that we went through for almost 15 years. Naturally, 50 years in RE/MAX, the average interest rate 7.78%.
Yeah.
As high as 17% in 1980.
But homes were a lot cheaper then, too.
Oh, yeah.
Right, so everyone says, well, I used to pay 14%. It's like, yeah, but you paid $48,000 for your home.
That's right. So right now, the market is hurt because there's more demand than there is supply. People that have 2.5%, 5% mortgages, 60% of the people who have mortgages are in that range. They won't move up and pay the 7% that's required today.
Yeah, and that's it. You're almost the business term golden handcuffs, right? Like you don't like your job, but you make too much to leave it. That's kind of where we are in real estate.
Exactly.
Right. You want to move, but you're like, well, you know what? I can't. I don't want to pay 7.5% on a new mortgage.
That will change. Right now, there's about 4 million resales a year. It should be closer to 6 to 7 million. If the interest rates start coming back down, people will start understanding a normal interest rate is 5.5%, 6%. And when that happens, I think you'll see a lot of people sell.
I have a number of friends and family members, some of whom are watching right now, that are real estate agents. And they're all kind of freaked out about this change, this do you need a buyer's agent? What's going to happen to commissions? You've been doing this half a century, Dave.
Yes.
You co-founded RE/MAX, one of, if not the biggest real estate agency firms. Congrats, by the way.
Thank you.
You paid a lot of mortgages yourself for your employees and put a lot of food on the table. Can you give them some words of comfort?
It seems chaotic in this market, but we've always been a cyclical business. And if you look at the oil embargoes, you look at 17% interest rates, you look at 2007 financial crisis, realtors learn to adapt, change their sales, and continue to succeed.
Are buyer's agents going away?
I think it's going to be a lot of pressure on buyer agents. We've had dual agency for 50, 60, 70 years. The buyer agency came about to thinking the buyer should have their own representative. NAR set it up to where the seller paid the commission and the seller's agent shared the commission. Okay, that's changing now. They've decided that does not work. And so the buyer agent is going to have to justify themselves.
And it's probably see some people leave the business, but to your point, they will adapt.
Google has now fired 50 employees it said were involved in protests at company offices over a cloud computing deal with Israel. Joining us right now on that and the FTC's new ban on non-compete clauses. Alex Heath, he's the deputy editor for The Verge and author of the Command Line newsletter. Also, Joanne Littman is here this morning at the table, lecturer at Yale University and a CNBC contributor. Good morning to both of you. Alex, I think you've woken up super early because I think you're on the West Coast this morning. So let's just talk Google. And I'm curious what you make of what's happened there, but also what you make of happening in terms of the culture in the Valley right now, going from this sort of open campus university model, say what you want, what you will, to what looks like a bigger clampdown.
Yeah, I mean, I think you just hit it on the head. I think Google personifies this culture shift that's happening across tech and really across corporate America, but especially in tech. With Google in particular, you've got a company where senior executives were on stage almost in tears in 2016 after Trump got elected, talking about that and the implications of that. And fast forward to this last week, you've got Sundar Pichai sending an email to all employees saying, "Hey, we don't want politics in the workplace." And this was right after they'd confirmed that they'd fired 28 employees, which for Google is unique, but also for the tech industry at large. I'm not sure we'd ever seen, especially since I've been covering tech for the last decade or so, an example of that many firings at once.
Here's the thing that I think we're all trying to understand is, when some of this began back in 16 and some of the protests in 18 and even in 20, there was and it felt like the employees were running the place, right? The inmates were running the asylum to some degree. And there was a view, I think, among management that they couldn't clamp down on this, even if they wanted to, because these engineers and their employees were so important, and that if, in fact, they actually did anything about these things, that they would have a bigger problem, that the labor market was so tight that these people would race off to other jobs. What is the sort of calculus today versus the calculus then?
I mean, I think you've seen a lot of power shift from the rank and file back to the company. And what was unusual about this protest is that it was a sit-in protest. So there were people physically impeding others and standing in the offices of the CEO of Google Cloud, for example. That is really taking things to a new level. Google is no stranger to protests, but I think they saw this as an opportunity to really put a flag down and say, look, we're not going to tolerate this kind of behavior. Okay, and then they ended up firing an additional 20.
So, Joanne, are you then of the view that this was just so egregious, but it's not really a cultural shift? Meaning the protests of old, which might not have actually happened literally in the physical office of the CEO of a division, those protests will be okay tomorrow, but these protests won't, or think this is a new paradigm?
I do think it's a new paradigm. We are seeing a cultural shift. I think about, it just so happened coincidentally in 2018, there was a huge walkout. It was about workplace culture. It was about sexual harassment. It was November 2018. I happened to be at the Googleplex, Google headquarters to give a talk that day. So I was in the midst of this. And it was supported by the company. It was huge, but it was peaceful, and it almost felt like a party, right? And you had this environment versus where you are today. And I think there's a couple of major differences that have happened. One is employers have been trying to pull back ever since, the pandemic, where employees all got the power. They're trying to pull some of that back. But there are a couple of real differences. And the hugest one, I think, is that in those 2018, 2016, you had employees who were together, who were pushing together, unified against management for whatever reason. Today, you have employee against employee.
It's much more splintered.
Much more splintered, and also you have employees who are saying, I'm feeling unsafe.
Alex, I want to talk about this FTC decision and how it's going to change things. California, by the way, has always been a state, or at least more recently has been a state where these non-competes are not always enforceable. Is this going to change the dynamic there? Or are we just talking about a different kind of worker? $150,000 seems to be the threshold for preventing non-competes in the future, but you do have to have some kind of policy-oriented role that could be potentially a little fuzzy and fungible.
Andrew, I haven't really seen a ton of high-profile high-profile examples of tech companies enforcing these non-competes. You've seen Amazon do it selectively. There was an example with, I believe, an executive who went to Google Cloud in the last few years where they tried to enforce a non-compete because he was coming from Seattle. But yeah, you're right. California hasn't had this. The California tech industry is the best tech industry and one of the best industries in the world. I haven't met anyone who likes a non-compete who isn't the one who's enforced it. So I think this is generally good. There's been a kind of chilling effect generally. But as it relates specifically to tech, I haven't seen a ton of examples of this actually being forced. I think it's more that kind of unspoken chilling effect.
Joanne, we got to go, so we only got 20 seconds. A good thing or a bad thing long-term for labor?
Oh, very much a good thing.
And if you were a CEO, you go to court over this or no?
I think they will go to court over this. I don't know that they'll win. I think the question is, does the FTC actually have the mandate? Do they have the power to put this into place? And I don't, we'll see how it plays out.
Our next guest, who, as we have pointed out quite a bit, accurately called the rally last year, and he was really lonely, says he's now very cautious on the market this year and favors value over growth stocks. Barry Bannister is chief equity strategist at Stifel. And I can remember I was complaining about how wrong everyone had been. And I think your people contacted us and said, here's the proof. And then you started coming on more. But I can vouch for what I just said on the air, that did happen. And nobody. Was there any, what would you say? It was about 5% of the street was bullish when you first got? 1 out of 20 of the people we have on. We still have on.
Well, I've always been better at bottom fishing than top ticking, and that's just my nature. We've had the view since last year that 2022 to 23 actually had a recession. That if you look at a recession, it's income, production, sales, employment, and fixed investment. The only thing that didn't weaken was employment. We're structurally short labor. We had a recession in everything else, like real retail sales. And so what we're doing now is recovering from a recession, which is why you've had this burst of productivity after a recession.
Not a classic recession.
No, we call it pseudo-recession. It was a major slowdown, like the mid-teens. We had one in the 80s. We had one in the O's. And because of that, the actions of the market are very much like a post-recession recovery, and that's what caught the Fed off guard, as the economy came back.
So why does that make you less bullish?
Well, when you think about it, the yield curve is inverted, meaning short rates are above long rates. And I think the yield curve will flatten. And a lot of people think, well, it's because the Fed's going to bring the short end down. But I actually think the long rates will go up. 5 was the norm before the financial crisis in 08, 5% on the 10-year. I think we'll see 5 again. And they'll cut a little bit, but their problem is messaging. You know, in the Greenspan Fed, and even Bernanke, when he took over from Greenspan, they kept rates at about 5. And so the Fed can cut a little bit and manage it like course corrections in a boat. But they can't really whack rates like they did in the last decade.
So your view on whether stocks continue to perform well is based on whether the Fed cuts or not?
No, the Fed is extremely important. I mean, you know, the market is the liquidity and rate-driven second derivative machine. But we just thought valuations, some of the the AI hype was a little overdone. So what we're looking for is a 10% correction off March 28th, which takes you down to about 4750 on the S&P 500. We'll trade around these ranges through the summer.
The E could be okay. The earnings could be okay, but the multiple might not. It might already be as good as it's going to get.
We had a minor earnings recession outside of tech. I mean, it was negative outside of just
better now, aren't we?
Yeah. And so what you're seeing is earnings. Employment, these are all late cycle phenomenon. And after the pseudo recession, you're going to get the recovery. So the Fed has to be on guard to that reacceleration.
Why a 10% correction with earnings going up 10%?
That's just it. The earnings aren't probably going to struggle to do 10 this year. I think it'll be a little south of 10.
So it's going to be multiple.
It's multiple compression as people realize that the interest rates have to. The normalize of interest rates is up, and it gets complicated. It has to do with R-star neutral rates, term premium, but generally speaking, we think we're in a higher rate environment for the long term. Multiples just got a little elevated on some of the hype, And that's what's got to come down.
Your hair's not on fire about inflation being worse than we're expecting. The Fed's going to have to actually tighten down the road instead of cutting. You just think we got ahead of ourselves. We get a 10% correction, and then we're back on track after that?
Well, the post-World War II average for the CPI headline inflation number is about 3.7% year over year, and 3 looks like we're going to be sticky at that level on the headline. So the core PCE inflation the Fed watches is about 2.5%. Okay. And a 2.5% core PCE world, the Fed's going to think, well, depending on the growth potential of the economy, we've got to keep rates a little closer to 5 than to 4, and that's what the adjustment is. The long end is going to be higher than the short end, and the short end is going to be higher than what people are used to.
When will you be as bullish as you were last year?
We'd have to have another bear market, and I do think there will be a bit of what we call a term premium shock that people are going to realize in 2025, next year, that the economy is bumping up on resource constraints. Inflation will bottom out and gradually turn up in May of 25, I think it is. I think Powell might be hiking rates again. And then the market would sell off again, and we get another great entry.
We've had a lot of.
You think a bear market 20% down?
That's probably more of a 2025 story, though.
Okay. But we do 10 this year, correction.
A 10% correction.
47.50 on the S&P.
You're saying.
And then
no, I think we rallied back. If you think back to the end of the year, we're going to have a relatively resilient economy, and what we've been focused on, we call it cyclical value. This would be a broadening out into financials, industrials, energy, basic materials, industrials. Some of those have already moved. But we think it'll broaden out in the fourth quarter. It'll be less tech-centric in terms of the recovery. But seasonally, I'm a little concerned between May and October. I just don't fight that too hard.
Guys, buyers on dips, if these companies, the stocks go down this week, because that's a central question right now to, whether there's going to be enough support around the names that have pulled back, of late in the last week or so. As the stocks have come in, dip buyers are going to save the day. They've done it the last couple of days. They've certainly picked up a number of these names, NVIDIA included. Right. Let's just say Meta goes down. Are you buying that dip?
Meta goes down, would buy the dip. Alphabet goes down, would buy the dip. Microsoft goes down, would buy the dip.
What about you, Weiss?
First of all, they're all my biggest positions, those 3.
Yeah.
If they went down substantially, I'd upsize for a trade, but since I'm full in those positions, not looking to add exposure, I mean, they're pretty significant. If I didn't have a full position in it, I absolutely would buy the dip, particularly on Meta and Google, because I believe that they're cheap relative to the market, relative to their growth rate. I'd say Microsoft's fairly valued at this level, but nonetheless.
Well, it's fairly valued. I mean, the multiples come in. We said.
Yep, it has, but I love them all as a point. Right, and if I weren't full, I'd buy the dip.
Statistically, Microsoft really matters. Let's not pretend it doesn't. It's a $3 trillion company. It's the largest company in the S&P 500. No, I know you didn't say that. It's the largest company, the S&P 500.
Yeah.
And if the second largest, Apple, is going to stumble like we think, well, we better get something good from Microsoft.
Yeah, no, I think people would agree with that. Bryn, I'll get you the same question, this idea of buying the dip. If you have an opportunity to add to these positions on pullbacks, would you do it?
Yeah, well, I mean, like Steve, I own a ton of tech, right? Like tech and energy definitely are my 2 biggest holdings. So yes, theoretically, I would buy the dip. I think it's a very, very, very unlikely Microsoft even has a dip. Google, on the other hand, I don't own it, but I wouldn't buy it. I think with Google, I still don't like the leadership scenario. Who runs this company? Is it Sundar or is it Sergey and Larry? When these other companies, it's very, very clear who the visionary is, who the leader is, how they're executing. I still think with Google, that top-level structure is very unappealing to me because I think that leads to an inability to make really important decisions. And I think one of the most important times within these technology companies.
But the stock performance would suggest otherwise, though, right? As we said, this goes towards the narrative not necessarily matching up with the fundamental performance of a stock, right? I mean, year to date, Alphabet's up 13%. Over the last year, it's up 50%. So where's the real problem, I guess is what I'm getting at. That's sort of a broader question to everybody, not you, but those who want to criticize Alphabet, even like the Gerstners of the world, right? He criticized it, he sold it, and then he saw the stock pull back, and then he bought it.
Yeah, sure. And obviously, when the information changes, we have the right to change our mind. When I'm underwriting an individual company, if I'm not going to buy one of my ETFs and I'm going to go into and buy an individual company, it comes down to the leadership, right? And so that's why I don't own Google. Is like, I don't know who runs this company. And so I can tell you Mark Zuckerberg, Elon Musk, Tim Cook, Satya and Amy, I can tell you exactly who's running it and what they're doing. You can't say that with Google. And so for me, with my strategy, that eliminates it from my portfolio.